Hi, welcome to PhillipCapital's Weekly Market Watch. I'm James Chua, Investment Solutions Specialist with PhillipCapital Management. So this week, I'm going to talk to you a little bit about the Phillips REIT Fund as well as REITs in general. We launched this REIT Fund last year in September, and so far the fund has grown to about 10 million. This is a fund that invests purely in REITs, and we started it mainly because we had demand from investors for an income-focused product. So why invest in REITs in the first place? The main thing about REITs is the stability of income. Basically, you have REITs owning buildings and buildings leasing out properties to commercial enterprises, offices, F&B, retail, and turns out that the income derived from a lot of these retail outfits and offices are actually very stable, in the sense that in the event of a recession, the offices and the commercial businesses continue to remain renting properties. An example is like 2008, the Lehman Brothers incident happened. Singapore moved into a recession along with the West, and if one actually took a walk down Orchard Road and just looked at some of the major buildings, you would still find occupancy rates close to 100% at that point. So what we find is that actually a lot of these businesses continue to remain renting out their main office space or their retail space in a recession, hence the stability. So some investors ask us, what are the main risks associated with investing in REITs? The risk is similar to a homeowner, in the sense that as a homeowner renting out property, you have two main issues that you would like to control. The first issue is, of course, the issue of your creditor or the bank. As long as your bank doesn't call on the loan and the bank is still willing to extend credit to you, you are okay and you can continue operating the business. The second thing that you have to watch out as a property owner is, of course, being able to get tenants. So with the REITs, is no different, in the sense that the REIT has to control its relationship with the bank, as well as to maintain high occupancy rates by being able to attract tenants. So some investors have asked us to comment about the effect that REITs have on prices. So REITs in general will actually lead to a cycle of higher prices over time. And this happens due to the REITs coming in, actually enhancing a property and actually increasing the rentals over time, which also has an effect on the property prices going up in the long run. So of course, depending on who you speak to, some people or some tenants, let's put it that way, actually like the REITs while others don't. Okay, so many of the tenants who actually we've spoken to, leasing out properties in REIT buildings, actually enjoy the REITs coming on board. Reason being, even though the rental is going up, the sales that these companies can generate from maintaining stores in a shopping mall actually goes up more than the rents that are going up as well. So I would say most of the tenants who continue to rent out space from REITs actually do enjoy an enhancement in terms of their sales from renting out REIT properties. Of course, if you're a very low cost operation, you actually may not like the fact that a REIT has come into the building and will charge higher rents over time. So I would say this issue, it depends on who you speak to, but generally, yes, we agree that REITs do cause higher prices in the long run in the market. I also would like to talk about REITs and asset allocation. We talk about asset allocation, a lot of things come into play, like for instance the age of the investor or the risk appetite of the investor. What we generally tell investors as well as financial advisors is, once or after the client has established his strategic asset allocation, say 50% stocks, 50% bonds, one can actually use REITs to substitute or complement the bond or equity holding. Let me explain. For example, you take an investor who starts with a 50% stock, 50% bond portfolio, and assuming you have the view that the market continues to improve from here, this investor may actually want to reduce his holdings in bonds and actually increase part of that holdings into REITs. That is to say, reduce his bond holding to say 30% and hold an additional 20% in REITs. This allocation to REITs can actually help the investor's portfolio to increase in value as the economy and the stock market improves, as well as to give him a decent yield. On the flip side of things, you take an investor who is 50% stocks, 50% bonds, and in a market where the market is weakening going forward, he may actually want to take part of his equity holding, say 50%, down to say 30%, by moving that 20% into REITs. So in this way, it has a risk reduction effect. But of course, to find out more, please talk to your financial advisor from Phillip. Thank you for watching. Please tune in again next week.